Welcome to the show. Be the boss of your money. I'm Mitch Goldberg. Thank you for joining us. We're talking about the beginning of the new quarter. It's time to quarterly rebalance and quietly, ever so quietly, Google, aka Alphabet, hits a new all-time high. So some things are working out for the better. Let's roll a quick intro. We'll talk about rebalancing, why it's important, what you need to know about it, what it means, and all those good things. Please stick around. If you have any questions, ask in the comments. And as always, give us a like or a heart, whatever reaction is available to you in social media. And if you're watching from YouTube, please subscribe. Here we go. All right. Thank you so much for joining me. A couple of things to catch up on. I hope everybody had a nice long weekend. Rebalancing. Let's talk about that real quick because NVIDIA and lots of other tech stocks, in particular the NASDAQ, the biggest stocks in the NASDAQ, have had big runs so far this year, continuing their big run from last year. And it means that a lot of people's portfolio risk metrics could be a little or a lot of out of whack for what people originally expected. For example, if your portfolio is only going to be 60% stock, 40% bonds, and now it's 80% stock and only 20% bonds, that's a completely different risk profile. One is a growth, one is a moderate growth. So which means you may be investing way out of your risk tolerance, comfortability. Okay, that's what I'm trying to say. So what you need to do is consider rebalancing your portfolio to get you back to 60% stock, 40% bonds. Now you might say, why do I want to do this? The market's been going up, things have been going up so much lately. Well, first of all, it's a fair question because the market could keep going up and you could keep making more and more money. And if your portfolio is up a lot, let's say your $1 million is now worth $1.4 million, but now you're 80% stock and only 20% bonds. We're not $1 million, you are 60% stock. So if the market keeps going up because you have so much more money in stocks, it really has an incredibly strong compounding effect to the upside. But the converse of that is it could also have a compound effect to the downside if the market reverses and goes down and we go into a severe or prolonged pullback, or I should say severe and or prolonged pullback. These are the risks that you have to be comfortable taking. Now, some of you might say, well, I'm only 40, I'm only 30, I'm only 50. I can wait. I want to wait. I don't want to rebalance. I want to take the chance that my portfolio could keep going up even if it goes backwards, because I believe that in the end, every bear market has grown into a new bull market with new highs. And people are very optimistic about that. The investor sentiment right now is pretty darn good. People are pretty excited. Even a few months ago when the market has been trading upward in a strong uptrend, people still weren't excited about the stock market. Only now do I feel like people are really excited about how the market's working, how positive it's been. But rebalancing puts discipline into your portfolio, because how many times have you said, the next time the market goes up a certain amount and my portfolio goes up to that level, I'm going to take some chips off the table, I'm going to sell. And how many of you said the next time the market goes down, I'm going to get in there and I'm going to buy? The problem is we don't do it. We don't know when those cataclysmic highs and lows are. Generally speaking, the stock market is only rarely marked with cataclysmic ups and downs. Usually it's just a matter of up and down, and within 10, 15, 20% rise, maybe a 5 or 10% correction, but the trend has always been up. Here's the problem though. This is why you can't always rely on the trend has always been up. Because when you get to a certain age, and I'm going to say around 55, 60, and you could add years to that, you could be 65, 70. It all depends on your personal situation. But let's say when you are up there in years, for what you consider to be up there in years, if the market has a severe correction and takes a long time to recover, that might substantially either reduce your spending power in retirement, or if you maintain the same spending power, or if you maintain the same spending power, you could run the risk. You could run the risk of losing money permanently. You could actually run out of money in your life much sooner than expected. This is why, as we get older, we typically tend to become more conservative in our outlook with our investments. We start to migrate more toward stable type of investments with a preservation component, cash equivalents, for example, intermediate term bonds. So that's why. Now, if you're shooting for a certain risk metric and you've done your risk analysis properly, you might know your risk metric. And investing to stay close to a risk metric is important. Now, I'm not saying that every time the market goes up, you should sell whatever your account gives you as it goes up a tiny bit and you should just rebalance every day. That's why we pick moments like either quarterly, semi-annual, or we pick annual times to rebalance. A lot of people who said they would rebalance at the end of last year didn't, because their accounts were going up and they got accustomed to the market going up. Now we had another good quarter. So what I'm seeing now are portfolios that are out of whack. And what I'm doing for my clients, of course, is we rebalance. But for those who say, I want to hold off from rebalancing, generally speaking, my clients don't tell me to hold off on rebalancing. We manage accounts on a discretionary basis. But there are those people that don't want to rebalance, and we are aware of who they are, and that's okay. It's their money. As long as they go into it with their eyes open, we're fine with it. We feel these investors have a little bit more sophistication, more skin in the game for sure, and they are also the type of investors who have accountability to themselves. So, having said all that, now is a time, quarterly or annually, to rebalance. If you want to bring your account down to a risk metric that is more like you, that you're comfortable with, because it's great to avoid rebalancing when the market's going up, but it sure works in reverse pretty hard when the market's going down. So that's why I say rebalancing is important. And for those of you who understand your risk tolerance and your portfolio is well out of your risk metric bounds, it's something that you need to do. On another note, quietly, ever so quietly, Google hit a 52-week high. Now, Google has been written off a lot lately because they missed the mark with artificial intelligence. But here they are. They're getting talked up again in artificial intelligence. Stock hit today a new year high. This is since the day it was trading, okay? I'm going back to the early 2000s. It has never been higher than where it is now. And the market cap is still under $2 trillion. The high today was 155.74, and stocks up over 11% this year, doing pretty well. But overall, large cap tech stocks have done well. What do you do with them? Similar to rebalancing, you might want to sell a couple of shares of these types of investments and put it into something differently. If you're going to rebalance out of tech stocks and take that money and buy more tech stocks, meaning you think you're going to have more diversification, I would say think again. Now, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in the generally down market. What I don't want to see people is rebalance out of tech and then take that money out that they just used in rebalancing and move some of that money into more tech stocks. I think if you really want to diversify properly, you add the money into a sector that you're light on. Maybe you're a little bit too light on utilities, or too light on energy, or too light on financials, or maybe maybe you're too light on another asset class like bonds. That to me is a much better way to rebalance. Don't rebalance to take profits and go into the same exact sectors that you just rebalanced out of. because birds of a feather typically fly together. You want to be in a different sector or a different type of asset class altogether. If you want to know more about this, you know where to find me, clientfirststrategy.com. I would love to hear from you. And if you'd like, give us a call, send us an email, clientfirststrategy.com. Thank you so much for listening. I hope you get a lot of value out of this. Let me know what your questions are in the comments. I will get back to you whether or not you're watching in the live stream or the replay. And now, I'd like to wish you a very good night.